Today we're joined by Andrew Rowan from Andrew Rowan Wealth Management. Andrew, rising interest rates, we've seen already the market in the share market has cooled a bit, and rising interest rates and trouble in Ukraine has led to markets coming off a bit. What impact do you think over the next 12 months that rising interest rates will have on the share market here and abroad?
Well, I think that what people need to understand is that we've had these massive asset price increases over the last few years now, certainly since the GFC of the bottom of 2008, 2009. The effect of falling interest rates has created asset price increases across the board, that is with share markets and property. So we would then expect as interest rates increase, asset prices will then fall in value. But I think it's important to point out that it's not necessarily the RBA that has their hands totally on a lever at the moment. Bond rates have gone up over 2% in the last 12 months. Now that 2% increase has coincided with share markets peaking in around August, September of last year, and we've seen a gradual slide off since, and that has been directly as a result of global bond prices. And a bond price is the price that the market is effectively charging the government to borrow money at. So we're seeing governments basically having to pay over 2% more for the money that they want to borrow. That's what they call the risk-free rate of return, and all other investments are benchmarked off that. So we will continue to see a softening of asset prices, share markets, investment property, commercial property, directly as a result of that.
Yeah, but it's safe to say that people shouldn't panic and think that the market's going to collapse or crash. It's important to take a much longer term view. The short term there might be some pain, but the longer term view should still be that you're better off being in the market than out of it. And trying to time getting out and getting back in is a recipe for disaster, history would suggest. So the long term view is still that the market's a good place to be, but short term there might be a bit further downside or potentially a bear market for a bit, but I think we just need to be patient and play the longer game and make sure that you don't panic and sell because share prices have come off a bit.
No, and the key thing about that is that what's happening at the moment is a normal part of the market. Now, we haven't seen it for some time, but in 30 years that I've been in this role, we've seen some significant short-term interest rate spikes over the years, and it always has an effect on asset prices. As you rightly say, timing the market is possibly the worst thing that people can try and do. Having an investment plan, having a strategy, continually investing your money over a period of time is the best way to grow your wealth.
And I always think that it's important to have a bit of cash on the sidelines to be able to take advantage of prices that come down by 10 to 20% is a normal correction that we'll have every 12 months to 2 years. So if you've got some cash on the sidelines and you can buy BHP 20% cheaper than what you could 12 months ago, then it's like going down the shops and picking up something that's on sale. Basically, it's a good solid company that has good long-term prospects. That I'm not saying buy BHP, by the way, but it's just an example. So don't go buying BHP. But it's one of those things that you just need to change your mindset that prices dropping means that you've got the potential to buy shares cheaper than what you could, a month, 2 months, 3 months ago. So
and the other thing I would say is that after June, when people get their superannuation statements, they might be a little bit disappointed or more disappointed in the returns than they have been in previous times, but that isn't a signal for them to get out of the super fund. It'll be that most funds follow what the market does, and that's what we would expect. Definitely, if people got concerns about returns or their superannuation, then they should get advice, but don't react to what's happening now in the markets because it's totally normal.
Thanks, Andrew.